Welcome to today's edition of ETF Central. My name is Bilal Little. I'm your host. I'm excited today to have Matt McLennan, the co-head of Global Value Investing and a portfolio manager of Global Value Investing at First Eagle Investments. They're a $160 billion asset manager, and in December, they launched 2 active ETFs. I'm really excited about this episode. Welcome to the show, Matt.
Thank you so much. I'm doing very well.
Good, excited. So help us understand your journey to First Eagle and what led you to the firm and why are you excited to be joining us today?
So sometimes you end up in a place that ultimately uses all of the bits of your life experience beforehand. And I'd grown up in Australia and started working at the Queensland Investment Corporation in global equities in Australia, and then went to Goldman. And at Goldman, I had a range of different experiences from equities. My first IPO I was involved with when I started on the banking side of Goldman was a gold mining IPO up in Papua New Guinea, where I happened to be born.
Okay.
And then I wound up in New York. And at part of that time, I was running value portfolios, global equity portfolios, and I also served a role on the investment strategy group. And that let me look at currencies, international markets versus the US, fixed income versus equities. Point being that First Eagle was a platform where I could look at all of those different markets in one vehicle.
Absolutely.
And I think the other thing too, you find out as you're going through your career, is you end up in a place where you're most comfortable in your own skin as an investor. And so like here, I think the one thing that distinguishes First Eagle is the temperament of patience. And, we're very long-term investors, and I felt very much at home at First Eagle, not just from a skill set standpoint, but a temperament standpoint. And I joined in 2008.
Wow. So let's go and stay with First Eagle and maybe just share a little bit about the firm, the organization, what you guys stand for, and what separates you from other asset managers.
So the ethos of what we do at First Eagle is resilient wealth creation. That's our true north.
That's a good way to say it.
Yeah, and I think it's important to understand that because from a differentiation standpoint, we tend to be much more focused on defining risk as avoiding the impairment of capital in real terms, as opposed to many strategies you might hear of in ETFs that define risk as tracking error to a benchmark.
Absolutely.
So firstly, we're focused on preserving capital in real terms, and that's an important thing. And I think the second thing is we try to achieve that, and I'm sure we'll get into this in more detail through this notion of scarcity value, bottom up. And temperament, as I alluded to, is very important at First Eagle. We're great believers not just in patient investing, much more like tending to the garden than mowing the lawn, but also very focused on having the humility to accept uncertainty in markets, and that makes you invest differently, and the flexibility to go globally. And so if you look at the different strategies at First Eagle, that focus on resilient wealth creation is pervasive, and the willingness to be flexible and to focus on parts of the market that lend themselves to high active share.
Wow, appreciate that. So I think it's only fitting to start the conversation extremely wide. Today's investment environment, there's no shortage of headlines. Rather it's inflation, rather it's global tension. How do you guys set the macro stage as a team for what you're going to communicate to clients as far as being able to follow these investment principles and philosophies?
Well, so I think even though we're inherently bottom up, one security at a time, you have to be willing to cast a wary eye to what can go wrong from a macro standpoint.
Yeah, for sure.
And I think if I reflect on the list of macro complexities that you just referenced, whether it's inflation and geopolitical tensions and the like, I think one of the variables that's kind of a root cause for those symptoms, if you will, is the situation we find ourselves in today globally, where we have a high degree of fiscal laxity. Budget deficits are high relative to where you'd expect them to be, given relatively low unemployment, not just in the United States, around the world. And so that means that one has to be more attuned to the fact that if the sovereigns are issuing more claims on themselves and they have a fixed real taxing ability, that we could have more nominal drift in the system, more inflationary drift over time. And so one of the things that we spend time communicating with our clients about is investing in a world where there's more sovereign risk.
Interesting. So stay with that, and let's talk about the opportunities that you actually see. I know we're just going to stay global and sort of macro here. We don't have to dive directly into the portfolio. But what are areas of the market that you guys like, and then areas of risk that you are concerned about?
Yeah. So if you think about that backdrop, where we have a greater sort of nominal growth or inflationary tendency in the system, then I think from a get-go, one has to be perhaps a little more cautious about assets that perhaps low volatility on the surface, but are fixed in nominal principle.
Okay.
Because if there's an upward shift at some point in the indeterminate future in inflation rates, you could lose real purchasing power owning things that are in fixed nominal value unless you have sufficiently high yield to compensate you for that rate of drift. The problem is if global sovereign debt's growing at 6 or 7% a year, you need a high yield to cover that threshold. And so for us, what that's meant at a big picture level is that when we implement our strategies, we're much more focused on securities or assets that we think have real positional value, that they may be a claim on a resource that's long duration in nature, that, were we to have more inflation, could preserve its purchasing power because the underlying price of that resource would go up, or land, or companies that have strong market share positions. Okay. If you're 50 or 60% market share of a narrow niche of the world economy, you have the ability over time to reprice your book of business to reflect the monetary equilibrium. And so I think the big picture take for us is if we're in this world of sovereign risk, focusing on companies with strong real assets and strong positional integrity is important to preserving value in real terms.
So let's unpack that a little further, right? Just thinking about U.S. and I would say globally, how are you identifying those particular companies? Is it valuation based? What are you actually looking for right now? Or what businesses do you like right now?
Yeah. So we start with the business first, and then we assess valuation. Okay. We feel that you have to feel comfortable in the persistence of a cash flow stream before you can put a multiple on that cash flow stream. And it sounds simple, but it's not. A lot of people either look for high quality businesses, irrespective of price, or growth stories, irrespective of price, or they might statistically filter the market based on price to cash flow, price to book, but then you end up with a business that might be questionable. And so at First Eagle, it's critical in our minds, start with the business and then assess price. And so if you think about those kinds of businesses that have good positional value, scarcity, as we would refer to it, they tend to have a few unique clusters. If it's a resource, they tend to have basins that are high ore grade and long duration. If it's real estate, they tend to be very centrally located, location.
Absolutely.
So premium rents. These companies can have cycles, but they have cash flow that has long duration and you can value them. And if it's a company that doesn't have tangible assets, but has intangible assets, there are different kinds of businesses we focus on. Businesses that might control a precision process. Okay. You might be the world leader in CNCs for factory automation, or you might be a world leader in bicycle brakes and gears with 50 or 60% market share. Those sorts of advantages give you scale in R&D and distribution. We focus on companies that have iconic brands. A brand that's been around for 100 years can survive cycles and has pricing power over time. And we focus on companies that have what we'd refer to as network effects. They could be, a bottler or a convenience store retailer that has the densest network of stores or bottling operation, or it could be virtual, like a social media platform or a software company that has high market share. And so if you loop all those together, high market share, sort of density of market position is kind of a common thread, similar to what you see in real assets. High ore grade or a central location is kind of density as well. Sure. And so scarcity and density in our minds kind of coexist.
All right. So I want to unpack some of this a little bit because I think it's really valuable. So I've known of First Eagle for nearly 20 years. And for most people at the investment level, we all have home country bias. So they're really concerned about going outside of the U.S. because these are businesses, to your point, that they may not know or be less familiar with. Every time I spoke to a financial advisor, First Eagle was where they source their international and or commodity exposure, particularly gold. Can you just unpack a little bit about your prowess there? Because it seems that you guys have built a ton of conviction in the financial advisor community.
So if you look at the our inception narrative for the global strategy, it started in 1979, and it started as a global strategy. So many other players started as US and then ventured into international, but our roots are deeply embedded in international markets. And I think there's a lot of institutional memory there.
Yeah.
I think the sort of second thing is that when people think of international investing, they tend to sort of line up the risks in their mind.
Okay.
But I think there's also opportunity. And I think one of the benefits that we've had, having been in these markets for a long period of time, is that you see that there's certain types of businesses that exist outside the United States. The US, as great an economy as it is, doesn't have a monopoly on all good businesses. So when you look outside the US, you might find the best luxury products companies.
Yep.
You might find eclectic holding companies that own stakes in other companies, but if you buy the holding company, you could get a double discount.
Okay.
There are factory automation companies in Japan that just have technology that's dominant relative to their peers globally.
Yeah.
There's real estate that is unique in different parts of the world. And so I think when you start from a position of looking globally, you realize that there are some unique pockets of scarcity that just happen to exist outside the US. And so we've always been at peace with the notion that we'll go where the opportunities are, wherever they may be. And that's part of a flexible temperament.
Yeah. Look, I think that's an important mandate, especially right now. If someone hires you to be the anchor of the portfolio, you're hiring someone to say, go out and identify the best opportunities for me.
Yeah.
Right. So I have to get your views on this before we go into like parts of the portfolio or how you guys manage capital. You've had a unique value perspective on gold through multiple cycles. I have to ask, I have to ask. Just talk a little bit about what you guys have identified in gold and how this particular cycle may be different.
So if we go back to the first risk that we talked about, which is that sovereigns are issuing securities on themselves at a faster pace, and that we think that the antidote to that, to a certain extent, is to own things that have real positional value. Well, gold is the embodiment of that. It offers no yield, but it doesn't have supply growth anywhere like the supply growth of sovereign debt. And
Absolutely.
So gold is a paradox. When I speak to people about gold, they're like, well, isn't it just like a useless lump of metal? Yeah. And I'm like, actually, you got to understand that the utility of gold as a potential hedge, as a monetary reserve, is its uselessness as a commodity. It's naturally got low beta. Historically, it's had its best decades when equities had its worst decades.
Yeah.
And so gold's chemical character means it's a natural perpetuity. It lasts forever. It's naturally defensive. And it happens to be scarce. So one way to think about gold is as scarce defensive land. And we've owned gold as a potential hedge in our mutual funds because it's preserved its real value over generations.
Yeah, for sure.
And it's tended to perform best when risk assets are in troubled waters. And so you can imagine it has a role in our portfolios as a potential hedge. But one thing I'll sort of point out is that we tend to be measured.
Yeah.
We don't want the portfolios to be a directional bet on
Absolutely.
that. And so in our mutual funds, gold tends to peak out at a mid-teens percentage of the portfolio, and gold and gold-related securities. And then, on the downside, we tend to keep it more than 5% because less than that, and it's not material as a potential hedge. It's just the same way a bank would think of its tier one capital.
Yeah. So you mentioned the mutual fund. I guess now would be a perfect segue and just to outline sort of how is the ETF that you're managing particularly aligned with that particular view, and how are you sort of allocating in the First Eagle Global Equity Strategy?
Absolutely. So if you think of how we got to offering an ETF, it's been a journey for us at First Eagle. I think one of the things that's important is that, for us at First Eagle, the client always comes first. So we started as a global mutual fund, and then over time, our clients desired components of that, whether it was international only, whether it was a U.S. value strategy, whether it was a gold bullion and gold miners fund.
Yeah.
At the same time, as clients' needs evolved, some people wanted separately managed accounts. Yeah. And more recently, there's been demand from our clients for an ETF vehicle for what we do. And so we listen to the clients, because we don't just want to have a unique philosophy. We want to be uniquely easy to deal with at First Eagle. And so that was the inception of the ETF. And now the ETFs themselves tend to be invested in the equity portion of our portfolios. And to the extent that we have gold-related investments, it tends to be through gold miners or royalty and streaming companies. And so our clients have come to us and said, we really want your equities. Happy for you to invest in some gold equities that are undervalued and good investments in a vehicle that meets our clients' idiosyncratic needs. And so that was the genesis of the ETF.
Look, and coming into this year, having a overweight to international equities would have been fantastic for a U.S.-based investor. You guys have outperformed, had a great start to the year. What do you attribute that to? Because if you look in the if you look under the hood a little bit, you have a company that I really like. I'm not going to ask you to point out any specific companies, but you have exposure to tech inside of your particular strategy, but you have this sort of global lens. Could you maybe just unpack a little bit more on sort of how you look at the world?
Yeah, so it's an interesting thing. If you start with the mindset that you're open-minded to opportunity, wherever it may be, perhaps it's not a surprise that our portfolios, in terms of the equities of our portfolios, almost evenly split between opportunities in the US and opportunities outside the US.
Great point.
Now that happens to make us underweight the US because the MSCI World today is nearly 3/4 in the US, despite the fact the US is a quarter of the world's GDP and about 5% of the world's population. And so the way we sort of look at it is we feel that our portfolio has a kind of balance to it in structure, but it does make us look different from the indices that sometimes get concentrated. People forget that Japan was the largest country in the MSCI World back in the late 80s. Can you imagine having the majority of your portfolio at that peak of that bubble?
Exactly.
So I think if your goal is to identify companies that have scarcity at a time when they represent value, you have to be willing to look at markets that may offer more value. And so when we got to the end of last year, international markets were, if you just looked at the ratio of the MSCI EFA to the MSCI US, we're at a 50-year low.
Wow.
And so perhaps unsurprisingly, we're just seeing a little bit more opportunity internationally. And I think given the enthusiasm of markets for the AI narrative, we were seeing some opportunity in more naturally defensive areas of the market where people didn't want what they perceived to be mundanity. And so we came into this year a little more international, a little more defensive, just by virtue of what we saw bottom up. And that's held us in good stead this year.
Yeah, so one would argue that U.S. markets are overvalued, right? We're touching all-time highs, and foreign investments are undervalued still, even though you've had obviously significant outperformance. Maybe expand on your views on sort of AI and tech globally, and how you see the world through that lens.
So we like growth. We just don't like to have to pay too much for it.
There it is. Yes.
That's the thing. Making money in investing is about the asymmetry between price and prospects, not just the identification of interesting prospects. And so we've been kind of open-minded to AI for some time now, and it's been scattered across different parts of our portfolio. We first started seeing it in the factory automation space, some of our Japanese holdings, where they were using AI for predictive maintenance in their fields of robots and other factory equipment. And then, we held shares in a very large relational database company. They started to use AI for self-maintaining database. And then, other parts of our portfolio used AI for either network optimization, think of the freight forwarding market, or for targeted advertising. And, you can guess the kinds of businesses that would use that. And so we started seeing use cases for it. And then I guess as we've gotten into this AI realm where everyone's been focused on one company, I guess the simple insight for us is that actually there's a whole ecosystem that's going to benefit here. There's going to be software companies that have to run the workload. They're not just going to benefit from the upfront sale of a semiconductor chip. There are other companies that need to fabricate the components of those chips that you don't have to pay such a premium valuation for. And there are companies that can use AI, and if they have strong market position, can hang on to the productivity benefits. And so we've been looking at AI from a kind of multi-dimensional standpoint. But when you look at our portfolios overall, even though we own a range of technology investments, it's less exposure than the market, just given how much valuations have ascended in that space.
Yeah, great point. I want to give you an opportunity to share with the audience a little bit about the two different strategies and how investors should think about First Eagle global equity, First Eagle overseas equity?
Absolutely. So if we think about First Eagle global equity, this is a strategy that will deploy capital into businesses that have some kind of incumbency advantage wherever they exist in the world, US or international.
Okay.
First Eagle overseas equity is basically those opportunities we see outside the United States. And the reason we have both is that some of our clients have come to us over the years and said, look, we love what you do internationally, but we have our own solutions domestically for one reason or another. And so they're building the component blocks themselves to an asset allocation, often top down. The people who come to us for First Eagle Global are saying, hey guys, we respect the fact that when you get to an asset allocation, it's the residual of what you're seeing bottom up, not top down. And so we want to have a core allocation to the global strategy so that the asset allocation evolves with the bottom up opportunity set. And so people come to us with different motivations, but that's just the essential difference between the two.
What would be the overlap between the two strategies?
So basically the non-US stocks in the global fund, very close to the international stocks.
Okay. And the international has zero allocation to U.S. domiciled, or what? Just so we're clear.
Incredibly low. I mean, it could episodically have a small, but from a fund structure standpoint, the substantial weight of the securities are going to be international.
Okay. And given where we are right now, so that's the level set of what the strategies are. The landscape obviously looks a little rocky. We have obviously Fed Chair coming out this week to discuss what their plans are. How do you envision the second half of 2025 going for your particular team and strategy as you deploy capital?
So, I think one of the things that we're grappling with at the moment is the possibility that, and you alluded to this earlier, that U.S. markets are in a moment of complacency. So we have the fiscal backdrop that I presented for you, and we have a degree of policy uncertainty. Recent tariff rates seem to be coming in a little higher than some people expected. On the other hand, after the passage of the most recent tax legislation, we're committing to a fairly rapid increase in the stock of government debt over time. And so we have this backdrop. At the same time that we don't have a lot of latency in the labor market. Yes, the unemployment rate tipped up a little bit from the mid threes to the low fours, but if you look at participation rates for prime age workers in the labor force, they're already high. If you look at prospective population growth, it's very low with immigration reform. And so if we get this kind of nominal drift in the economy, this excess demand from accommodative fiscal policy, if the labor market were to reaccelerate at some point, that could lead to a resurfacing of inflationary pressures. On the other hand, if we end up raising tariffs a lot higher than people expect, and it's a fiscal contraction that's meaningful, you could get a recessionary dynamic. And so there's these tail states of higher interest rates, either if you do nothing fiscally, or higher credit spreads if you do too much fiscally. And yet when we look at equity markets and credit markets in the US, they're priced with low spreads and high multiples. And so, we worry a little bit about that from a macro standpoint.
It's funny, you brought up something that I was going to stay away from, but I have to just throw it out here. So recently, President Trump just reached a deal with the European Union, and we will basically have a 15% tariff coming, obviously, from that particular agreement. And then also they will acquire energy from the United States. How does your team sort of factor in some of that data and how it will impact the businesses that you guys invest in?
Well, the first thing I'd say is that the ultimate outcome in these trade deals is uncertain. I'd say at this point, they're more memorandums of understanding. Okay. And let's not lose sight of the fact that the tariffs themselves are being challenged from a legal standpoint.
Absolutely.
And Great so, point. We're just, the federal courts are in a hearing process about whether or not the president was beyond his constitutional ability to enact tariffs. And so we don't know what the final tariff situation will be, but let's just take it for what it is on the surface. I think we view it as a kind of backdoor consumption tax.
Okay.
In a sense.
Yeah.
And so there's an element of fiscal contraction in it, which will either hurt corporate profit margins in the US or hurt consumers because the things will cost more.
Yeah.
I think if you had to construct a positive side of it, perhaps it addresses some of our trade flow issues. I think long term, the question mark I have in my mind, and there's sort of no answer for this, is on the one hand, the idea is to attract investment in the US and manufacturing and all that sort of stuff. But on the other hand, if you're doing that by virtue of tariffs, the rest of the world is adapting to become more competitive. And, we've already seen that in China. As their exports to the US have gone down, their exports to the rest of the world have gone up.
Yeah.
And so these are incredibly complex. I think the key thing for us as investors is that we think there's risk everywhere from a change in generational trading patterns. But the risk is arguably being better priced in international markets that trade at lower multiples.
I used to work at BlackRock, and one of the things we used to spend a lot of time on was portfolio construction with financial advisors. And one of the things we would say is risk isn't bad, it isn't good, it just is.
Yeah.
So you have to understand it, right? And know where it is and know how to obviously source it appropriately for your portfolio. Given that, thinking about a tactical change, if any, that you've made recently, care to share? Is it raising cash? Is it taking wins or gains, I should say? Is it looking at other areas to deploy capital? I just want to get a sense, given the market dynamic is shifting so quickly.
I love the way you express that risk just is.
Yeah.
And sometimes when we think of risk, we think of it in a statistical term, like normal distributions and things like that. But true risk is uncertainty, right?
Completely.
Where you don't even know what the distribution
Right.
is. And that is.
Yeah.
And so the question is price. Back to the discussion we had before about the asymmetry between price and prospects. And so tactically, our portfolio evolves in response to what prices are on offer for quality businesses.
Yeah, for sure.
And so in a strange way, if you know the kinds of businesses you'd like to be owners of and the price points that make sense, then volatility is your friend, not your enemy.
Absolutely.
And so this year, if you think about the path of our portfolios this year, when the markets melted down in April, you might imagine that we were able to rotate some capital from cash and consumer staples and buy some other businesses and industrials or more economically sensitive areas. In the portfolios that had gold, we were able to trim a little gold at attractive prices and invest into equities. More recently, as you might imagine, with equities having rallied to new highs, we might be trimming some names that are starting to get a little rich relative to our sense of intrinsic value. And so the point I want to get across here is if risk just is, then you have to acknowledge up front your ability to predict the zigzags and zags of the market in advance is constrained. But if you have the right mindset, you can take advantage of market moves after the fact.
Great point. So for the advisor who says, who is First Eagle and one thing that I should know about them, what would you say?
Resilient wealth creation for the long term. We are a grinded out strategy. And I think by virtue of the sort of extreme focus on the long term, I guess the one thing that I hear back from our clients is that they've felt comfortable being with us for the long haul, and their clients have benefited from the long-term compounding. I think there are many other strategies that can generate outsized returns in up markets when people have fear of missing out. But then, that attracts people often at the wrong time. There are other strategies that are so defensive, they're unwilling to take risk that's well priced. And they could do well when there's a fear of wipeout. But over cycles, they don't produce real wealth creation. And so I guess the niche that we inhabit is resilient wealth creation, sort of curating the business garden for the long term.
Absolutely.
And that's what we're known for by our clients.
I like how you said, risk at the wrong time. In a world today where, everyone's kind of just chasing the headline or chasing the hot dot or taking on too much leverage into a risk, I think they forget about the impact of loss. Just the math of it, right?
It's so true. If you're down 50%, you have to be up 100% to break even. So you can win more long-term by losing less short-term.
I feel like as an equity investor globally, right? You have a good sense also on what's happening in the fixed income market. Not saying that that's your primary market, but care to share any just general thoughts on sort of where things are?
Yeah, it's a really interesting moment in fixed income markets because the forward end of the curve, I'm talking treasuries now, and the long end are telling two different stories. The forward end of the curve is saying, hey, we're expecting a few cuts as the economy is sort of slowing down. The long end of the curve, if you zero out and get some helicopter perspective, has broken out on the upside after a 40-year downtrend.
Wow.
So the long end is starting to sniff these sovereign risk elements that we were talking about before. The yield on the long end is starting to try and catch up to the rate at which the stock of government debt is growing. If you're going to be a 30-year holder of treasuries, you want to be compensated for the rate of issuance in treasuries.
Without a doubt.
And so you have this kind of stretch between the hopes for the short term and the emergent fears in the long term.
Yeah.
And so I think that the critical issue for treasuries and other sovereign bond yields is really going to be the extent to which credible fiscal strategies emerge. If they don't, we could be in for a window like the 70s where you had a decade or more where interest rates were volatile but trending higher. And then there's the credit side of fixed income where, I guess we see that credit spreads are pretty low right now. They're pricing a Goldilocks scenario, kind of like the front end of the treasury curve.
Yeah.
And that for us has been a time of where we're perhaps a little less willing to take risk.
Yeah. If you don't mind sharing, from your institutional clients, what are you seeing from a new allocation perspective? Have they added any areas that I would say most people haven't paid attention to?
Look, I think one of the things that's going on at a very high level is that by virtue of the degree of concentration in markets the last few years in terms of where outsized returns have been, there's been tremendous flows into a small number of names in growthier strategies in the US market. And I think just institutionally, we're getting a lot more sort of feedback or inquiry or focus on strategies that are either more diversified, particularly international, to your comments earlier, perhaps more price sensitive, and valuation being an important consideration there, and strategies that have good, attractive liquidity characteristics because they've tended to make fairly large and sizable allocations to less liquid strategies. And so that's kind of what we're hearing at the moment from some of our institutional clients.
Love it. So this is where I give you an opportunity to share something that's in your lineup. It doesn't have to be an ETF, that you have as an investment vehicle. It could be a separate account. It can be a mutual fund. It doesn't matter. What I call the underdog in the portfolio. Something that no one pays attention to, an area of the market that hasn't received the attention that it should. It might be significantly undervalued. Is there anything in the chassis that you'd like to share?
Well, I think you hit on it before, which is the sort of the international stocks. And in a sense, yes, they've performed quite well comparatively this year. But if you zoom out and look at the last 50 years of history, the outperformance is but a blip. And one of the things that we've noticed is that sometimes the regimes shift, and they can shift for a decade at a time. There were decades during the 80s and 90s where the dollar was strong and the S&P was strong. And there were other decades where the dollar was weak and EFA, international stocks, were strong. And so we've just started to see a potential inflection in that. Now, the crystal ball is foggy at best. We can't predict. But I do think that when we look at our portfolios, the range of investment opportunities we see in the international equity universe is quite compelling. Doesn't mean we're not finding compelling opportunities in the US, but if you're looking for what has been the underdog that could have legs and is showing some green shoots, I think the First Eagle overseas equity is an interesting place to start.
Matt, thank you so much. I really appreciate you coming down to ETF Central.
Thank you so much. Enjoyed the conversation.